Welcome to Inside Economics. I'm Mark Sandy, the Chief Economist of Moody's Analytics, and I'm joined by my two colleagues and co-hosts, Cris. Cris is the Deputy Chief Economist, and Ryan Sweet. Ryan's the Director of Real-Time Economics. Hi, guys. How's everybody?
Good. How are you, Mark?
I'm tired, actually. I'm on a global world tour. Week number one is in Europe, and that's now starting to wind down. And I've got the Middle East coming up and then Asia after that. So,
Cris, did you notice this? This is like the fourth consecutive podcast. He says he's tired.
Really? Is that true?
It's at least 2 or 3, maybe 4. I don't know.
Well, there's no Wawa coffee in Europe. So
that is definitely a problem. I mean, I'm having these flat whites. Have you ever had a flat white?
Yeah,
they're good, but they're not Wawa. They're not Wawa.
Yeah, there's no hazelnut.
And there's no hazelnut, and they're too small. They give you something like this, a few ounces. I don't know. Maybe that's what it is. Maybe I'm just not getting my coffee.
I think so. I think
I'm surprised you don't pack it.
That's got to be
my solution to everything. So.
Yeah, it's got to be it. Anyway, a lot going on over here in London. If you've not noticed, we definitely should talk about that, and we'll come back to it. Of course, a lot's going on in the U.S. as well. We had this devastating Hurricane Ian, which, by the way, came pretty close to my home in Vero. All is okay. A lot of leaves and branches on the ground, but nothing damaging. But it looks like it did a lot of damage. And I know, Ryan, you've done a lot of work trying to assess the economic consequences of that. So let's talk about that. But before we go to those two things, why don't we chat about we got a lot of statistics this week, a lot of data. So maybe just an open-ended question to you, Ryan. What of all that data do you want to talk about? What do you think is most interesting in terms of shedding light on what's going on in the economy and where we're headed?
I think we should start with GDP. So this was our third estimate of second quarter GDP, but it also included the annual benchmark revision. So anything between 2017 and 2022 was subject to revision. So what I took away from the revisions is the level of GDP is now 1% higher than it was previously thought. GDI, which we thought GDP is going to get revised towards GDI, was actually the opposite. GDI got revised. GDI is gross domestic income.
Yep.
And it's just two ways of measuring the economy. GDP is the value of all goods and services we produce, and GDI just sums up the income part. So rents, profits, wages and salaries, things like that. And there was a sizable downward revision to GDI. So that difference between GDP and GDI shrank quite significantly. And the other thing that I noticed was inflation got revised up this year.
Can I ask on that, Ryan?
Yep.
So GDP, since the pandemic, got revised up a bit. You said about a percentage point. And GDI got revised down. And so it now looks like the gap between the two, the difference between two is back to historical norms. It had gotten as wide as it had ever been in history, the so-called statistical discrepancy. Mm-hmm. That's the difference between GDP and GDI. But now that discrepancy is back to normal or typical.
Yeah, exactly. And this is what happened after the financial crisis. So that statistical discrepancy got really wide. I think, if I remember correctly, it was at the time the widest on record. And then after these subsequent revisions, it gets wiped away. So that's not too surprising. But I was hoping GDP would get revised up more. We still have those two consecutive declines in GDP in the first half of this year. But GDI got revised lower. And looking at the components, it was profits, which the government always has a hard time measuring profits, in real time, but also wages and salaries, and that the BEA, the Bureau of Economic Analysis, their estimate of compensation, wages and compensation, was getting out of line with the data that we get from the Bureau of Labor Statistics, so the so-called labor income proxy. So there's this gap that was dividing, and now that gap is closed. So I was disappointed that we didn't get a bigger upper revision to GDP. I was hoping we'd wipe away at least one of those declines in the first half of the year.
Well, I mean, I think the thinking is that the best measure of what's going on is the average of GDP and GDI. And do you guys know if you take the average?
Use that as my stat. I'm going to have to change my stat.
Oh, sorry about that.
Oh, it's all right. So the average is now got revised lower, and the average of GDP and GDI fell 0.4% annualized in the first quarter and 0.3% annualized in the second quarter. So
Okay.
before, both the average had risen, now they're showing a decline.
Okay. But it's still pretty flattish, right? 0.4, 0.3. You said
Yeah.
annualized. So
Correct.
okay. And
And
of
you're
course,
still not declaring recession based on that, right?
no, well, would you? I mean,
No.
yeah,
But some
mean,
would, right? They're,
yeah,
again, going back to the
some
old
have.
textbook
Yeah.
rule of thumb. But
Well, I'd also point out the revisions are only beginning, right? Because this is every year you get 5 years of revision. So
right, and then we get the big benchmark one that occurs in a few years. So that's going to be telling.
So I don't think the story's actually quite been written here yet. We'll see.
Mm-mm.
but even if it holds, right? The
Yeah.
labor market, other indicators don't confirm
Yeah.
a recession in the first quarter, at least.
That's the most important thing. But just for optics and a Pyrrhic victory, I'm not conceding defeat here. I suspect that data will be revised, and at least one of those quarters will go positive. And even by that benchmark, this would not be 2 quarters of consecutive declines. We would not achieve that. But of course, I got to wait a long time for that to happen, at least another year or so. But okay. And then you mentioned inflation. There was also some revisions. The Bureau of Economic Analysis, when they released the GDP revisions, also released revisions to their price measures. And so there were some revisions there as well.
There was. So the core PC deflator, which is the Fed's preferred measure of inflation, in the second quarter got revised up from 4.3% annualized to, or 4.4% annualized to 4.7% annualized. Seems like a small upper revision, but that's going in the wrong direction and just supports the Fed's very hawkish tone. It may require a little bit more hiking than what we previously thought.
Right. Okay.
So if you run through our macro model, it takes roughly another 50 basis points in rate hikes to reduce inflation by that 30 basis point revision that we got.
Really? That's what our model says? It takes a half point more on the funds rate target to reduce inflation by 0.3%?
Correct.
Huh. Core underlying inflation.
Core underlying inflation.
Interesting. Okay. And do we know what's the base, why fundamentally was behind the revisions? Anything in any particular aspect of inflation that caused the revisions?
That's a great question. The BEA changed their source data for one of the inputs into the PC deflator from, they were using the PPI for used and new vehicles, and they switched it over to the CPI. And we all know that the CPI for new vehicles grew gangbusters. So that, I think that my gut is that's a big source of it.
I see. Interesting. Okay. That's because vehicle prices have gone skyward here. So that alone would make a big difference, I would think. Yeah.
Yeah. And that's why with all these annual revisions, you got to read through all the, we can get in the weeds. So you got to read through these technical notes and they tell you like what changes they made and methodology changes. And that's why, this over the weekend and next week, I got to change our high frequency GDP model to kind of reflect these changes in the source data. So to make sure that we get it right.
Right. Okay. And right now in Q3, based on your tracking estimate, where are we? And of course, this takes all the different monthly data, weekly data that comes in, and we have a model that takes that and translates that into what it means for GDP growth in the current quarter, Q3. And where is that right now?
A positive 1% annualized. So this time last week, we're at 0.8% annualized. Now we're up to 1%. And the reason that it got nudged up was durable goods orders. So they came in, stronger than we anticipated and the model anticipated, and that kind of nudged up business investment in the third quarter. Okay.
So it feels like, correct me if I'm wrong, but it feels like business investment, not in structures, not in buildings, but in equipment and software, intellectual property, that seems to be holding up pretty well.
Yeah, it has.
Is that fair to say?
Yeah, I think it's a fair assessment. I mean, there's some signs of weakening ahead, like the ISM new orders that kind of leads core capital goods shipments, and that's showing signs of softening, over the next few months, but nothing that would raise alarm bells.
Yeah. Okay. Hey, Cris, these revisions to the BEA did to GDP and to GDI and to the inflation statistics, how does that influence your thinking about where the economy is and where it's headed, or pretty consistent with your thinking?
I would say fairly consistent, but again, as kind of Ryan alluded to, our hope was that GDP was going to go towards GDI upward versus the opposite. So it does suggest that the economy certainly is weaker than we might have otherwise had hoped for. But I don't know that it significantly changes the picture. I think we already accepted that it was weakening, whether or not it was recession. So I don't know that this really changes things in terms of the outlook or even in terms of the Fed's policy, right? So there's still more script to be written in terms of the inflation measures as well. So I think they'll take those with a grain of salt.
Yeah. Okay. Okay. Any other, I mean, I want to play the game, the statistics game, so I don't want to steal too many statistics here, but any other, because seems like there's a raft of data that came out this week. Any other of those data you want to call out? I did notice UI claims, unemployment insurance claims, initial unemployment insurance claims, kind of a window into layoffs. They fell to below 200,000 in the last week. And of course, anything between south of 250 would be a pretty strong job market. South of 200 feels like rip roaring. Is there something weird going on with that data that there may be some technical, well, maybe the hurricane affected that?
Well, the hurricane hit Puerto Rico, and Puerto Rico, they're not captured in monthly employment or GDP, but they are captured in UI claims, so unemployment insurance benefits. And when you get a hurricane, normally that depresses initial claims for a week or two, because when you lose power, people can't file, and also they can't be processed for UI benefits. So usually hurricanes depress it for 1-2 weeks, and then you get this big spike as this backlog of people filing gets worked through. So we're likely going to see claims remain low next week. They'll be higher than 193, but then the Hurricane Ian's effect on Florida, that's going to show up in a couple of weeks.
Okay. All right. Well, maybe that's where we should go now. Let's just go to the hurricane. Obviously that's done a lot of damage to the state of Florida. Here we are, September 30th, 2022. So that it hit Florida yesterday and done a lot of damage. Now it's in South Carolina, I believe, or headed in that direction.
I think it's headed in that direction.
Yeah, headed in that direction. What kind of assessment do you have of that? Because we do this work to assess the economic loss related to natural disasters like hurricanes when they're meaningful. This is clearly meaningful, both in terms of the business disruption, how much lost economic activity due to businesses closing and other activities shutting down, and then also the physical damage. Do you have any assessment of the economic consequences at this point?
Yeah, so what we did, we look at daily output in the counties that were most significantly affected by the hurricane. And by our calculations, it's going to be roughly 7 to 10 billion in lost economic output. Now, a lot of money is going to flow into the region. So that the number sounds small, but federal aid, insurance money is going to flow in, and then you're going to get a lot of rebuilding. So that kind of offsets some of the loss, the net loss in economic output. But 10 billion is still a lot. Damage, I think we're estimating 50 to 60 billion. So this is going to be one of the costliest hurricanes on record.
So as much as $10 billion in lost economic output because of lost electricity, businesses shut down, can't operate.
You're going to have businesses shut down, you're going to have businesses that close. You're going to have the big hit is because of lost power. And I think last time I saw, it's like over 1 million people still don't have power. And that's going to disrupt businesses. And the hurricane occurred during the work week. And that's when daily economic output is higher. Usually during the weekends, it's lower. And that kind of boosted the hit to those regional economies.
I see. And then of course, insurance money comes in, and then some government aid will likely come in for sure. And so that would lift economic activity. So we'll get some of that lost economic. And then of course, some of the activity that didn't get done will get done. Some will never get done. Like airplanes won't fly twice as many flights, but we'll get. But
right, think about restaurants. Like people aren't going to go out and eat 2 or 3 times because they couldn't during the hurricane.
Disney World, right?
Yeah,
Oh,
Disney
there,
World closed.
Disney
Yep.
World. Yeah, that got affected. Yeah. And of course, this is a script still being written.
Yeah.
Correct.
Right. Because it has, we'll have to see what it does, how much damage it does to the Carolinas and the rest of the Eastern Seaboard, I guess, at some point.
Yeah, and the other thing
How
that
does
always
this-
comes up with hurricanes is the broken window fallacy.
Yeah.
Does hurricanes really actually net boost the economy? And there's a
Yeah.
big difference between economic activity and economic welfare. So, these people that are affected by the hurricane aren't better off, but you're going to see a lot of economic activities rebuilding, and the money you mentioned flows into them.
One thing I've noticed, because we're doing a lot of work in this area around the climate risk, and obviously these kind of natural disasters are part of the climate risk that we're facing, is that in recent decades, I'd say the last 3-4 decades, if you total up the lost economic output and the physical damage, and then you look at the insurance money, private insurance money, and the government aid that comes in, it's almost 1-for-1. It's almost like the government fills the hole in the economy left by private insurance. So, you go to Katrina, that less insurance, more government money. You go to Superstorm Sandy, it was kind of flipped. There's more private insurance, less government aid. It's kind of a regularity in the response, to which I find fascinating. And it does feel like, obviously you take this big hit and then you get this money flowing in economic activity. And at the end of all of that, you're saying we still don't quite get back. The economy doesn't quite get back. The capital stock, the physical stock doesn't quite get back to where it was before the pandemic, before the natural disaster occurred.
Correct.
Yeah, interesting. What about any damage to oil, natural gas, refining operations, anything like that? This was Florida, so
Yeah, it dodged all the main energy infrastructure in the Gulf, up by Louisiana and all that. None of that was affected. So
yeah, that's the one nightmare I have, that hurricane's going to blow through the Gulf, shut down all those platforms, hit the coast, wipe out a refinery for a few weeks, and then got gas prices going back up to $5 a gallon. And given where we are, that would be pretty debilitating economically.
that's why Hurricane Katrina was such a larger impact on the macro economy, the U.S. economy. So this one's going to be small. It's going to shave a few tenths of a percentage point off GDP, but Hurricane Katrina did a lot more damage because gasoline prices spiked.
Oh, that's interesting. So you think Q4 GDP will be, we'll see a bit of a hit there, or because it's coming at the very end of Q3. So
yeah, I don't think it'll show up there.
Will it show up in Q3? Should, I guess, right?
It should.
Yeah. Interesting.
Yeah.
And then we get, I don't know. Yeah. We'll see how,
you do get the insurance money perhaps flowing. I don't know. It's
yeah,
get some hit, but you'll get some benefit.
Correct.
Do you know, Ryan or Cris, if you line up the economic loss and the physical damage and compare Ian to other storms, where it lines up, is it a big one or is it kind of in the middle?
We put it on the website yesterday. I can pull it up.
Yeah, Laura Ratz did a nice article on this, and based on that table that she produced, it looked like it was number 7. Right, so Katrina, Harvey, Maria, they're much worse, and then so kind of in the middle, if you will.
Today's dollars, Cris?
In inflation adjusted dollars, right?
Okay, so that's pretty meaningful then.
It's significant. Yeah, definitely. And this is an initial estimate. To your point, it's not over yet. We're not,
Yeah, right.
Yeah, I mean, if it hits the Carolinas, we're gonna add that into it.
That could be significant. So
yeah, and of course it comes up the East Coast and flooding and all kinds of stuff. Even here, when we're in Philadelphia, we got nailed by a big storm last year. I can't remember the name of it. Do you remember?
There was a lot of flooding.
Right? Ida. That did a lot of damage. I can remember Schuylkill Expressway was underwater. In the city. The Vine Street. Where goes on down Vine Street. It was just completely a lake. Did a lot of damage.
And that was like the remnants of a storm. I can't imagine.
I know.
It making landfall like
direct hit.
Yeah. Okay. All right. Okay. Let's play the game, the statistics game. And as you all know, but I'll just repeat it for those that don't. And by the way, I'm a bit of a podcast proselytizer. I don't know if you guys are as well. So every event I speak at, every podcast I do for someone else, webinar, I say, you got to listen to this podcast. And there's always someone in the audience that huge fan. Like here in London, we had an event, a conference, and we had a number of real big fans in the audience. Actually, people coming up and saying, I love your podcast. So, but I proselytize. So there are people who join every week that don't know the statistics game. So we've got to clue them in. And it's very simple. We each put forward a statistic or two. The rest of the group tries to figure out what that is through clues and questions, deductive reasoning. The best statistic is one that is not so easy that we all get it very quickly, one that's not so hard that we never get it, one it would be bonuses if it's relevant to the topic at hand. Of course, Ryan is really good at this. I have to say I'm maybe better.
Okay.
Someone's got to keep score. We don't keep score. We haven't kept score for all year. Someone's got to go back and look at the annals here and the historical annals.
We got to do that, and we have to bring back
Ryan
the
is
dollar.
so confident.
We have to bring back the dollar bets too. That's
Oh yeah.
All I know is I'm going to win the dollar bet on long-term interest rates. You guys really, what we have to go
Well,
back.
it took bad policy to get to your interest rate forecast.
Right. Okay. Who wants to go first? Cris, you go first.
I'll go. Sure.
Yeah.
Negative 0.6%.
Isn't that GDP and
In the second
real
quarter.
GDP decline minus 0.6% in Q2?
No, that's
No,
not
wait.
the one I'm. That's not the
But
one I'm
that-
thinking of.
But that is the right minus
Yes,
0.6.
that's the correct number. There could be a lot of minus.
That was
0.6s.
my. That's my tricky dodge. Yeah.
Oh, okay. So there's
That is
another
in the GDP
minus
report?
0.6.
There were a lot of 0.3s in this week as well. Just to
I know.
mix it up, but this is not. This is not related to GDP.
Okay.
All right.
Is it a statistic that came out this week?
Oh, I know what it is. It's house prices. They fell 6.6% month over month.
Oh, where's my bell?
Oh, very good.
That's all right,
Yeah,
Mark. You're jet lagged.
Although let's add, we got to make sure he knows what he's really talking about. Which index? Because there's two indices that
There were
came out this
two.
week, if I'm not mistaken.
Ooh,
The
One was
S&P.
0.6. The other one was not.
Keith Schiller, right?
Oh,
No.
no,
See
it's
that?
FHFA purchase
Ah,
only monthly.
So that is definitely a blemish, right?
That's a blemish.
All right.
It's fine.
Okay.
How do I take back the cowbell?
Yeah. No, you can't take it back.
So that was the FHFA house price series. The monthly house price series fell minus 0.6 in the month of July, I believe, right?
Yes, that's right.
Yeah.
And that is significant. That's a large decline. You have to go back to 2007, start of the housing crisis, to get that type of a monthly decline.
I mean, that's pretty significant. And they do, did you look at it regionally? Did you have a,
I did.
Okay.
I did. So, all right. So bonus question, which is,
yeah,
there was only one region that actually showed any growth.
East, North, Central.
Oh, wow. You really,
Wow.
Now, Ryan,
That's impressive.
that's impressive.
That's impressive.
Okay, now here's the bonus. This is
The number.
you guys, which states are in the East, North, Central region? Do you guys know? Oh my gosh. Come on.
East, North, Central. To be honest, I didn't even know that was a region. Like,
Oh, well, I think I got this right. Someone's going to correct me if I've got it wrong, but that includes Michigan, Ohio, Indiana, Illinois, and Wisconsin. Am I right?
I'm looking it up.
Yeah.
Illinois, Indiana, Michigan.
Yeah, Wisconsin. Did you mention Wisconsin?
Got it.
Yeah.
Yeah. Well, that's
Wisconsin.
impressive.
Okay. All right. Now, how about you want to know the capitals of each of those states? No. Okay.
I want to know all the metropolitan areas.
Yeah. Well, Mark probably knows the metros.
Yeah. Well, those. I know that stuff because back in the day, that we really focused on a lot of regional issues, East, North, Central.
Bread and butter.
Okay.
So which,
go
sorry.
ahead. Go ahead. Go ahead.
Well, let's keep going. That which of the divisions actually experienced the fastest growth over the last year?
Over the last year.
Yeah.
Ooh, that's interesting. Is it the mountain region?
Nope. I would have
South
thought so too.
Atlantic.
South Atlantic. Very good.
Ah,
Very good.
South Atlantic.
And the weakest?
Northeast.
Over the past year.
Yep.
Oh, over the past year, I would have to say
Think of a big state.
the
New-
Mid-Atlantic,
No,
North New England.
no.
Oh, is it
Weakest growth
California?
of Pacific. Yeah.
Oh,
Uh-huh.
really? Already on a year-over-year? Because I
On a
know
year-
it's experiencing pretty big declines now. The biggest, I think.
It is now and then over the last year as well.
Oh, is that right? It's come down that much.
It only
Wow.
grew. It only grew 10% over the last year.
Can I ask you a question about that?
Yeah.
In my stylized fact, and I'm not, tell me if I got the fact right, and then what's going on. The most significant price declines so far have been in California, really Bay Area, LA, San Diego, gotten creamed. In the strongest market, big market, not small market, big market has really been Florida. Florida's held up much better. Like I think in that data, Miami's still seeing price gains.
Gains. Yeah.
This is an example. How do you explain that? What do you think is going on there? That regional difference. I don't expect that to continue forever. I think Florida prices are going to go down. But why that difference, do you think?
So the tech industry, right? Certainly facing some layoffs.
Okay, yeah,
some
right.
weakness there.
Yeah.
If we think about the Bay, California is also always expensive, right? So
Yeah,
you're starting from a very expensive proposition. So any weakness can kind of multiply. So that would be my working hypothesis.
or maybe I guess that's a good reason. I would have thought my intuition was same thing, but it would be affordability. The price is high.
Yeah.
That's right.
And the mortgage rate rises and the mortgage payment becomes prohibitive in places.
Exactly. That's what I meant. Yeah.
Oh, that's what you meant.
That they feel because it's already unaffordable, right? Any little additional cost is going to drive out demand significantly.
Right. And then Florida, what do you think is going on there? Why is that held up better?
So Florida's interesting because you had a lot of migration into Florida. Naples actually, by our house price index, Naples, Florida was the fastest growing metro over the past 2 years, right? So lots of increase there, but it's not at the top of our list in terms of overvaluation risk because you also had a lot of wealth, a lot of higher income individuals moving there. So I think that provides some ballast to those markets, right? So people aren't perhaps forced to sell or don't need to sell.
Makes sense.
That provides some.
Yeah. Now, have you noticed mortgage rates? I mean,
Yeah, they've come down a little bit.
Down to what, like 6.5 or?
No, not that much. They're below 7. Chris knows
Below
probably
7.
exactly what they are.
Yeah, I mean, they're high. I mean, that's
very
definitely higher than we expected. And it partly goes to the higher Treasury yields, interest rates across the board have risen.
But the spread,
the spread, yeah.
That's been persistently high.
That's the mortgage rate, the difference between the mortgage rate and the 10-year yield, which captures lots of stuff like prepayment risk, credit risk, the cost of origination, the cost of servicing, all those things are in there. But typically the difference between a 30-year fixed and a 10-year treasury yield is like 150 basis points, right? 1.5 percentage points. And now it's double that. It's just double that. Do you have and that's a real problem. I mean, if it was a normal spread, the 30-year fix would be going for 5.5, not 7, right? And that would be much more manageable. And that's more consistent with what our forecast was. We didn't expect this gapping out of the mortgage spread and thus the mortgage rate. So what do you suppose is going on there? Why is that spread so wide?
I guess it comes down in essence back always to supply and demand on the MBS side. So some lack of liquidity, or you have investors worried about prepayment risk, putting in some additional premium. Inverted yield curve does strange things to expectations of how borrowers are going to perform in the future.
One bond trader I talked to I think he's right, was pointing out that you have extraordinary interest rate volatility.
Yeah.
Mhm.
Rates are jumping all over the place. And when that happens, the option, the prepayment option is the value of that is a lot higher because
Right.
that the compensation investors need to taking that risk is higher, and that gets built into the spread, and that goes to what's going on over here in London and the UK, which we'll come back to, but also Fed policy. As long as the Fed's on the warpath and people don't really know when that's going to come to an end and at what rate is they're going to stop and what it all means, you can get this significant up and back and all around on rates, and that's creating this higher prepayment risk and that's adding to the mortgage rate. Does that sound right to you?
Yeah. The other point is that you just made is the Fed, of course, right?
The Fed.
They are no longer a buyer of MBS securities. So
good point.
Pretty significant buyer. And although it's unlikely that they will sell that portfolio, it's not out of the realm of possibility as well. So there could be some additional supply that comes online that could take out the prices too. So.
Well, hopefully that spread normalizes at some point, because if it doesn't, we're going to have to change our forecast on housing too. If it stays around 6.5%, 7%, that means affordability is worse, demand's going to be worse, sales are going to be lower, and house price declines, which we're expecting, are going to be more severe. So
that's right. Yeah, and this decline, to your point, 0.6% was in July, right? So we're still backward looking here. It's not even fully capturing.
What was the mortgage rate in July? It was like 5.5%.
Yeah, I think 6 maybe.
Did it get that high? Okay.
At the highest, I think.
Pending home sales are tanking, and pending home sales lead existing homes by 1 to 2 months, and pending home sales are down 24% year over year.
Did we get another data point on that this week? I missed it.
We did.
Yeah.
That's data for August. So now we're looking at sales in September and October for existing, and it doesn't look good.
Oh boy.
I don't think it was much worse than July, if that.
No, but
it's any solace.
Yeah, it's just consistently
Not that it's
dropping,
plummeting, but it's very low. And traffic, all the metrics are down.
Yep.
What about you, Ryan? What's your statistic of the week?
How about you go? Because mine's going to lead into the last thing we got to talk about.
Oh, okay, fine. And we're talking about London, UK, the British, and what's going on here.
That's a big hint.
Chaos. 3.5%. 3.5%. Is
this a long-term interest rate?
It is not.
Oh.
It's a statistic that was released this week. It's an important statistic.
Refers to the US.
Yes, indeed. It refers to the American household.
Oh, the savings rate?
The savings rate.
Yes.
There you go.
There you go.
Personal saving rate, 3.5%. Yeah, good way to go, Ryan. That was the saving rate in the month of August, 3.5, and that is pretty low by the standards of recent history. You go back pre-pandemic, the saving rate was north of 7%. In fact, that got revised higher. The saving rate got revised substantially higher coming into the pandemic, but it was well over 7%. And so now it's half of what it was. And we calculate what we call extra saving. That's the savings that household did above which they would have typically done during the pandemic, if not for the pandemic. So that goes to household sheltering in place, not spending, generally high income households, and also government support that went to a lot of middle and lower income households. And that excess saving built dramatically during the pandemic. In fact, it peaked, by our calculation, in December of 2021. So at the end of last year, at $2.7 trillion. So that's over 10% of GDP. It's been coming down ever since because the saving rate's been below that 7% threshold that was established before the pandemic. It's down $400 billion, and we're now sitting at 2.2 trillion. Still a lot of extra savings, but it's coming in pretty quickly. And one other thing we've been learning, looking at other data from the Federal Reserve, is that households in the bottom part of the income distribution, the bottom quintile, the bottom 20% of the income distribution, actually blown through their excess saving, or appears to that they've blown through, and they have they have less cash in their checking accounts and deposit accounts than they did prior to the start of the pandemic. So, this hit to the economy from higher inflation, higher oil, gasoline prices, food prices, rent. Consumers have cushioned the blow by allowing their savings to come down and draw down the excess saving they have in their bank accounts. Also, they've started to borrow a bit more, particularly again those lower income households that are most stressed and have blown through their savings more quickly. They seem to be using their credit cards and taking on personal loans, more aggressively to help supplement their income. So this has been a pretty significant cushion to the economy during this period. But still, a reason to be. It depends on how your prism here, but a reason for optimism, right? Because it means that consumers have a lot of firepower there that they can use, a cushion that they can call upon if they need to supplement their incomes to keep on spending, and hopefully that keeps the economy out of recession. But the other way of looking at it is, well, it doesn't, if it keeps consumers from not becoming more cautious in their spending, and the economy doesn't slow sufficiently, then the Fed's going to have to, because of the high inflation, step on the brakes even harder.
Yep.
So now those two interpretations, which do you think is, or maybe there's another one interpretation, which one do you think is most relevant? Cris, do you have a perspective? I go, as you can tell, I go for the optimistic perspective that this is a cushion, but curious how you view it.
It is a cushion. I agree with, but again, to your point, the demographics are quite different, right, in terms of the impact. So,
yeah, but most of the spending is done by folks in the top part of the distribution, right? Mm-hmm. So, there's a lot of in terms of the macro consequences.
So in terms of the macro consequences, yes, it's a benefit.
Yeah,
but have to stress that there are certainly households that are already suffering in this environment, right? And that cushion is no longer there, or even if the cushion exists, it's certainly diminishing.
Yeah. Okay. What about the other interpretation that it's too much of a cushion? It's not allowing consumers to pull back enough to allow the economy to moderate sufficiently to bring in the wage and price pressures.
I don't see a lot of evidence that consumers are going crazy.
Yeah.
Even at the high end, right, where there is a lot of excess savings. So I don't know that it's really influencing the behavior to that degree.
Right. Which is pretty amazing when you think about it, because it's actually cash, sitting in their checking account. Like when they go pull money, go use their debit card, they can see how much cash is sitting there. I mean, it's like literally right there, they can spend it. But the consumers have not been doing that. They've been drawing it down, but pretty judiciously, and it basically just supplementing their real income, not doing any more than that. They're not spending with any kind of abandon. That doesn't appear to be. So
I think they're seeing it as wealth, and some of that cash is just waiting to be redeployed. The market's stabilized, so I don't think the consumers view it as available spending.
It's actually cash. They don't view it as cash. They view it as
they should. That they
I just don't want to invest in the
abandon.
stock market right now.
Yeah, I don't know what to do.
I don't know what to do.
I don't see any good investments out there. I'm worried about everything, so I'm just going to park it in cash and wait. So.
Yeah. Okay. Ryan, what's your statistic?
All right. It's going to be a little, you already got a big clue. It's something related to the UK. 130.
Okay.
130 basis points.
Pardon me? Basis points. 130 basis points.
130 basis points.
Mm-hmm.
Is that the increase in the 10-year gilt?
Over what period of time?
Last week? Since they announced the budget, the new fiscal plan.
Over the last month. That's good, Mark. That's impressive.
That's good. Good.
I bet it really.
Most of it's been over the last few days.
I'm sure it's over the last few. I'm guessing.
No, but the actual increase over the last month is 130 basis points.
It is.
Most of that has occurred over the last, couple
last few days. Yeah. No cowbell? What's that all about?
All right, all right.
Well, that's a good one. Yeah. And what is do you know what the 10-year gilt is today?
4.08%.
4.08. Okay.
Yep.
And I
So
do
for
know,
perspective, over the last month, the 10-year Treasury yield is up 54 basis points.
is that right? The
Mhm.
10 years up 54 basis points.
Now
and it's
53.
sitting at 3.67 or something like
3.73.
3.73.
Mhm.
Okay. And it had gotten as high as 4. And
It
the
did.
10-year gilt, that's the equivalent of the 10-year bond issued by the British government to finance their budget, their government. I think it got to 4.8 when I was
Yep.
here.
Before the Bank of England
That's
made their U-turn.
right. When the Bank of England decided that they're going to start, they stopped no QT. I'm not selling bonds, which they had announced, and now they're going to be buying bonds, QE.
Mhm. They
Buying bonds.
panicked.
Well,
Well, they
it
had
felt
to.
like they needed to do something, right? Because it was starting to disrupt I think the pension system here, because
Mhm.
you had a lot of pension funds that had bought into this scheme that would help them manage their interest rate risk, and it kind of got flipped upside down, and then they started getting margin calls and had to put more money in, and so they were worried about the pension fund system here, so
Mhm.
they felt like they had to do something. Well, let me ask you this. Let me describe what is going on here, so people have context. And I'm really curious what you guys think about all of this. There's turmoil here in the UK. As of today, it's winding down. It's a Friday afternoon. Markets are calmer because of the Bank of England's decision to come buy to QE to buy bonds. But it's been a tumultuous week, and it was ignited when the new British government, they have a new prime minister, Liz Truss. Is it Liz Truss? Truss. I think it's Liz Truss.
Mhm.
Announced a very large fiscal package, deficit financed, as they would say here, unfunded. So that means they're going to go out and borrow money, take that money and provide really large tax cuts, not targeted,
Right.
large corporations, wealthy households, and then also increase spending. This is now to help with the energy bills. So energy prices are up everywhere. They're up a lot here, more here in Europe, because more closely tied to Russia. And the idea is to cap how much prices will rise, energy prices will rise, and so that's spending, government spending. And again, that was untargeted. Everyone gets that, whether you're low income, high income, doesn't matter. And it's a lot of money, and it's a lot of juice. And this economy, is our economy to the second power. I mean, you think we have a tight labor market? They have an excruciatingly tight labor market. Their unemployment rate's close to ours, but their full employment unemployment rate's a lot higher than ours. Wage growth is very strong. Unions are stronger here, so the wage price dynamics are a bit more vexed here. Wages are feeding into prices into wages, so inflationary pressures are developing. So investors, global investors, seeing all that, balked and said, "What the heck are you doing? This makes no sense whatsoever." And by the way, count me in that camp. This is so off the rails, this policy at this point in time. I keep thinking I must be missing something. What am I missing, here? But it turns out everyone agrees with me. This is really bad. And so they've started selling the bonds, the British bonds, because they said, are you going to be able to pay me back in a timely way, because you're going to be borrowing so much money. And on top of that, because you're going to juice up the economy in the near term, you're going to fan inflationary pressures. You may create this stagflation environment. And the only way out of that is by really jacking up interest rates. The Bank of England will have to jack up interest rates to wring that out. And that'll end very badly for everybody, including the British, because a very, very severe recession. Not in the near term. Everything's all juiced up in the near term, so no recession now. But you look out a year from now, a year and a half from now, looks like it's going to be a complete mess. So the only thing that settled all this down, and this is important all over the world because it was reverberating all around the world, affecting bond markets, including our bond market and our interest rates, was for the Bank of England to do a U-turn instead of, because they had announced quantitative tightening along with the Fed and every other central bank to try to slow the economy and quell inflation. And now they're QEing, they're buying bonds again, a lot of bonds.
Yep.
That's the only thing and I wonder how long that calm lasts, if the new government persists and continues down the road here and trying to implement this policy. So what do you guys think of, your perspective on this similar to mine, that this is like off the rails, at kind of about as egregious a policy step that one could imagine?
I mean, if you recall from our stagflation podcast, we said one of the causes is bad policy, and this fiscal policy is bad policy.
Yeah.
And the Bank of England has to respond. They have a single mandate, and that's inflation. So any inflation that fiscal policy adds to the economy, the Bank of England has to offset that. So that means very, very aggressive rate hikes are coming.
So this is the fiscal dominance argument, right? That fiscal authorities can do what they want, and the central bank just has to mop it up.
Well, the issue though here might be that they don't do a good job mopping up, or they don't mop up quickly.
Yeah,
right.
Or they don't have the sufficient resources to mop up.
Right. I mean, in addition to her Liz Truss, the new prime minister's new policy, she also came out and said that she would want to review the Bank of England's framework for setting monetary policy.
Yeah, this is going down a bad road. This is not going to end well.
Yeah.
And then when the Bank of England steps in and buys those bonds, and I hear them saying, I need to do this to save the pension system and market functioning and all that kind of stuff. But on the other hand, it's limited
and it's short term.
Right.
I mean, that doesn't. I guess we'll see how aggressive the Bank of England will now be in their efforts to mop up, to take away this growth that is going to be juiced up by the fiscal policy. But at this point, it feels like their credibility is questionable, right? I mean, and that's another reason to be a bit nervous if you're an investor and concerned about stagflation. It's when the central bank doesn't aggressively respond to the inflation. That feels like that might be an issue here in the UK.
So right now,
government's not backing down. Is there popular support? I mean, you're there.
No, I think they're 30 points down relative to their Tory party, the Conservative Party. They're down 30. I think last poll, saw it this morning, 30 percentage points, 30 relative to the Labour Party. So it's not popular, even though you're cutting taxes and you're capping the energy bill. People are very fearful of it because, the other thing I didn't mention, the obvious, is the pound. The value of the pound is cratered, right? So investors say, I'm not buying, British bonds, and that's caused the pound to go down. And we got close to parity, and that's, I've been coming to London for 30 years, and I went to dinner the other night and got the bill, and it just came out of my mouth. I said, this is cheap. Can you imagine that? This is cheap. No one ever says that about London, but it's just like amazingly cheap, when it's compared to the US dollar now at close to parity. It's the strongest the dollar's ever been, I think, ever relative to. Yeah. So that's what's scary, spooking people, right? Because interestingly enough, in the United States, the thing that plays the most central role in people's thought process around their finances and the economy is the cost of a gallon of gasoline. Right. You know what it is here in the UK?
The pound.
It's the pound. It's the pound. It's like a litmus test for how things are going. And right now, it's not going well whatsoever. So,
what's your call?
How this plays out.
Does she blink? What's your call? Is she going to blink, or what's the forecast?
They said the Chancellor of the Exchequer, kind of the person who kind of manages this policy, came out and said there's part 2 coming. So we'll see what part 2 looks like. If they double down and there's more fiscal stimulus, I think run for
Wow.
the hills. It's going to be a mess. If they kind of find a face-saving way to kind of do a UE or a semi-UE or something like that, I think maybe this works out a little bit better. But we'll see. Either way, I think the UK is the economy is going to suffer a pretty serious recession. I think odds here are very high going in.
So we've got brinksmanship in UK and in Russia now. So that's
I know.
Makes for a dark scenario.
Yeah. I'm not even going to ask for recession odds. We did that in a whole podcast. We'll come back to that next week. But yeah, a lot to be worried about here for sure. Okay. Anything else before we call this a podcast?
I think that's it.
Covered a lot of ground. Okay. Very good. Anything, Cris, you want to bring up?
No, I think that's good for now.
All right. We're going to call this a podcast. Actually, I think, believe it or not, the next one I do, I'm going to be in Singapore. So Singapore is going to be quite late at night when we do it.
Another perspective.
Because we get the employment report next week, right?
We do.
Next Friday. Yeah. So we'll be doing that. I always look forward to that. We get our other colleagues on as well. So with that, we're going to call this a podcast. Thank you, everyone. Take care now.